market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the record-breaking stock rally is gaining fresh momentum after we had earnings from TSMC, which helps quash concern about overheating in the tech sector. There could be headwinds on the horizon as President Trump then seeks to make big tech pay for the surging costs of powering energy-hungry data centers. Well, joining us now is Matt Blockson, technology analyst at Bloomberg Intelligence, and in a moment we'll speak to Alex Brazier of BlackRock. So, Matt, good news, no bubble for now.
Well, yeah, I think the jury's still out on the bubble question, but I think certainly the markets clearly breathed a sigh of relief after the news from TSMC yesterday, particularly that CapEx is going to be up kind of 15 to 20% year over year, increasing by maybe kind of as much as $10–12 billion on the back of a strong forward pipeline from TSMC's big customers like Nvidia and Apple. So I think it's clear that the big hyperscalers are going to continue to invest big numbers in building out infrastructure in 2026. I think the big question still, though, is what is the natural demand, particularly from the enterprise market, to support all those investments over the midterm. We won't see the answer to that question until earliest the second half of this year, probably into 27 and beyond, because a lot of corporates are still kind of moving from that kind of pilot phase into the big critical question: do we double down on these investments? Is AI making enough of an impact in terms of extra productivity or additional market opportunities to justify the big incremental investments that these massive capacity investments are there to support?
Okay. And Matt, what are the practicalities, I guess, and the implications of President Trump saying that he wants tech companies to pay for electricity costs?
Yeah, so there's an interesting development. So I think we're going to hear news today of a suggested auction, particularly kind of in the kind of Northwest Atlantic area. Now, Virginia is in that, and Virginia is the single biggest market for data centers in the world, and there's a massive capacity squeeze there. Electric prices have been going up. Clearly, there are midterms coming up. President Trump and the administration want to see the economy looking healthy. So I think the fact that he's looking at mechanisms to carve out the power that data center companies need so that it has less direct impact onto the consumer market is kind of an interesting move. We'll have to see today the details of what they're planning, but it looks like there's going to be an auction that compels data center operators to buy electricity on a forward 15-year view, whether they use that electricity or not. So it gives the kind of power supply companies some visibility about how they're going to deliver capacity into the market.
Matt, Taiwan is also downplaying concerns that its tech industry is being hollowed out by U.S. trade deal. The chief financial officer of TSMC tells Bloomberg the company will keep its best technology at home, but is aiming to expand in the U.S. Here he is.
We don't look at it this way. It really depends on customer demand. In the U.S., a lot of customer wants to go there, so we will expand over there. But for the leading edge technologies, it will be in Taiwan because it's a heavy cooperation between the R&D people and operation people for practical reasons.
And leading edge will continue to be led by Taiwan, you think, over the US market, and that no changes to that at all, even with you adding a lot more capacity in the States?
Yeah, that's for practical reasons.
Is it possible, though, to speed up how quickly that advanced tech can be shifted from Taiwan to the States?
Yeah, we can try to do that, to shorten the gap.
What does that transfer gap look like then? If right now it's several years, Taiwan is ahead, what does that actually look like in the future?
We don't have a specific timeline now, but we can try to accelerate that. We think we can try to accelerate.
Could it be shortened to months, do you think?
It will be difficult, challenging.
Okay, so it stays at least one year behind then.
So, Matt, President Trump wants, of course, the best to be made in the U.S., but not so simple.
No, it isn't. The supply chain resilience theme is going to continue for quite some time, and obviously TSMC is also investing in Europe. What we heard there is absolutely true that there's years and years and years, and if not decades, of expertise and infrastructure in Taiwan to support the kind of leading edge semiconductor development. You can't just flip a switch and replicate both the infrastructure and the human capital expertise that goes into kind of delivering that stuff. So I think it's definitely not going to be months. It's going to continue to be years to kind of replicate this. And in some ways, there's parallels here with what Apple's doing. Apple's obviously looking to kind of take capability out of China, put it into India. That's been a multi-year process for them to kind of deliver on that. So I think, again, for TSMC, as much pressure as the Trump administration puts on them, there's always going to be a leading expertise in Taiwan, and it's a question of how quickly they can replicate that in the US. But it's not months, it's years.
Matt, thank you so much. Matt Bloxham, they're a tech analyst at Bloomberg Intelligence. Now, to dive deeper into the markets, with us now Alex Brazier, Global Head of Investment and Portfolio Solutions at BlackRock. Alex, great to speak to you. When you look at AI, I know you've gone from kind of liking investing in AI to also around AI. What does that look like?
Well, one of the big debates has, of course, been, is AI in a bubble? We really don't think so. We think valuations look high, but they actually are driven by fundamentals, and many of the core companies at the core of the AI theme have every opportunity to, if you like, grow out of those valuations. Now, the market's becoming, though, more discerning within the core of the AI theme, so we actually think it's worth spending active security selection budget on that part of the market. But also the AI theme's broadening out. We've just talked about power demand coming from it. We've seen great interest from many investors into clean energy, sustainable energy, energy of any sort, which is going to be needed to power the AI revolution. And that's where one of the bottlenecks is. Plus, as Matt was talking, at some point this will become adopted more broadly in the wider economy. That will help to support the surge in productivity that we're seeing. It's helping to deliver a broadening of earnings growth into the broader US economy. And so we've been tactically overweight US equities for quite some time as the market broadens out, as it's doing at the moment.
But at the same time, Alex, I mean, how can you tell when there's going to be a bubble? Because valuations just keep on rising, and every time we have, constructive news from TSMC or Nvidia, everything's fine. But at some point, it's got to match what you're spending.
I would push back on valuations keep rising. Actually, valuations for the mega caps have fallen. Earnings growth has been so strong that actually we ended 2025 valuations slightly lower. So again, it's not really a bubble, it's sort of fundamentals driven. Now the question is, will the hyperscalers in the long run be the ones who actually earn the most from all of this, or will the benefits be more diffused across the economy? And that actually leads to opportunities, we think, beyond what's worked well so far. So we're thinking about the sectors in the US economy that have the opportunity to adopt AI and deliver productivity improvements. But lots of investors are nervous about volatility at these valuations. And when we survey investors across Europe, they're pretty polarized. When we say, do you want to add to US exposure or subtract from US exposure? They say yes. But they're pretty evenly split between both of those options. And for the camp that's looking to reduce US exposure, they are worried about the high level of valuations, not because it's a bubble, but because they rest on some optimistic assumptions. And so they're looking, for example, at buffering their US exposure, giving up some upside to cap the downside. They're looking at tactical opportunities type strategies that are going to be pretty nimble through the course of the year to deal with that volatility. So there's a range of approaches people are taking in this environment.
Alex, how do you deal with shocks? So what we've been taught since January 4th of this year is actually nothing certain right now. So we're expecting maybe strikes on Iran, although the president has walked it back. Unclear what he does with a lot of the oil companies in Venezuela, and you don't really know what happens in Greenland, so what happens next? So how do you plan for this world which anything could happen at any moment?
I would say three things are going on. This is what's exactly on many investors' minds. The first is that people are looking in Europe to diversify geographically, to look to European exposures, Japanese exposures, and continued exposure to emerging markets. That's one. The second is investors are more and more alert to the need to be nimble through the course of the year. Our tactical opportunities strategies, looking back at previous years, have typically added about 5 percentage points of return through the year from moving from where they were at the beginning of the year. And so, to your point, that's exactly the environment we're in. We need to be more tactical and nimble. But the third thing I would say is, in addition to buffering strategies, people are looking to take down broad market beta exposure in portfolios. When you're less certain about the direction of the broad market, actually it makes sense to look in portfolios for more relative value opportunities, more alpha, if you like. And so one of the key trends we've seen in portfolios over the last 12, 18 months is the introduction of more and more liquid alternative and hedge fund type strategies in portfolios to deal with the uncertainty you described.
What do you see going on in China? So are we importing deflation from China? And actually, again, a lot of this foreign policy coming from the U.S. is not directed against China, but they're the net losers in this. Do they retaliate?
Yeah, I think in Europe, the particular challenge now is that a lot of Chinese goods have, of course, pivoted away from the US and are coming now into Europe. So European manufacturing, we've seen under a lot of pressure from increased competition, well known around the automotive sector, particularly from China. Now, that probably will lead to a policy response at some stage, but it's also part of a sort of structural change we're seeing going on in the European economy, away from, if you like, traditional manufacturing and exporting to Asia towards defence and more domestically focused companies. So we see opportunities in Europe continued in defence and in broader value sectors.
What makes you worry the most about markets? I mean, you're fairly sanguine or fairly optimistic. Is there something that doesn't feel right now?
I don't know about not feel right, but I think when you look at valuations, they make total sense in the context of the productivity surge we've seen going on in the United States over the last 3 or 4 quarters. That actually has made many of the worries people had, you're old enough to remember last April, many of the worries people had then actually go away. Because with a productivity surge, the fiscal position makes sense, interest rates can come down, growth can be strong.
But inflation could come back
with a vengeance. If some of that productivity actually proves to be a bit more transitory than people are currently expecting, then we're in a scenario where the Fed either can't cut rates like markets are expecting, or it does cut rates into a more inflationary environment, which is not great for the long end, not great for the dollar. So more generally, this is an environment where if some of the risks do materialise, it's not a kind of environment where stocks and bonds are moving in a nice opposite direction. So again, for portfolios, it means looking at buffering type strategies to take down volatility. It means looking at hedge funds and liquid alternatives. But it also means in this volatile environment, people are looking for more steady income in the portfolio. They're looking less at growth and high risk-taking, more income generation in the portfolio, which is why people have broadened out to lots more emerging market local currency debt, to securitized assets, and to more sort of unconstrained income generation strategies.
Alex, what's your take on the UK? So we've had a number of high-profile, also conservative Tory, MPs actually moving to reform. I don't know whether that changes the policy and complicates things even further for this Labour government.
I think the big issue at the moment in the UK, we've seen a string of news this week, actually, not to do with the politics, but to do with the economics. And the two issues that we're monitoring are, one, that growth, although it surprised a bit on the upside in the monthly number, is still pretty anemic. Yeah. We're running at an annual rate of kind of 0.5%. There's nothing to really write home about. And that's an environment where the labour market continues to loosen. Second thing we've seen is that some of the inflation indicators continue to come off. So these sort of Indeed wage measure coming down, city inflation expectations coming down. And that's an environment where rates can continue to come down. And when you look at the market pricing of the Bank of England versus, say, the Fed, they're priced to be moving pretty much in lockstep. And yet one economy has anemic growth, no productivity surge, and wage growth coming down. The United States has a productivity surge going on, strong growth. So it seems to us that that relative play between the UK and the US offers an interesting opportunity in that context.
But do you worry that this government is not bold enough? So actually you're not going to see that kind of growth, and in 12 months the UK market will be less attractive than other places? Well,
one area where the government is being bold is around fiscal consolidation. I think it's underestimated, actually, quite how much consolidation is actually going on right now and that we're in the middle of. You see lots of talk about back-end loading, but it's going on. Yeah. It's going on right now. And the market started to give the government some credit for that. And as yields come down, I think some of that pressure on the fiscal position will ease a bit. Yeah. But growth looks pretty weak. UK equities have done reasonably well, but it's been very narrow. It's been very narrow in financials and aerospace and defence. We'd prefer broader European defence, some of the European value sectors and emerging markets.
So interesting. Alex, thank you so much for joining us.
Thanks
Alex Brazier, they're Global Head of Investment Portfolio Solutions at BlackRock. Coming up, the JP Morgan Chief Executive rules out ever becoming Fed Chair, but there's one top job Jamie Dimon would consider. Or would he? Find out next. This is Bloomberg. The The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Jamie Dimon, the JP Morgan chief executive, has ruled out ever becoming chair of the Federal Reserve, but he said he would consider the role of Treasury Secretary. Well, Dimon spoke with Bloomberg host and Carlyle co-founder and co-chairman David Rubenstein.
Chairman of the Fed, I'd put the absolutely, positively, no chance, no way, no how for any reason. Okay? Secretary of Treasury, I would consider, if a president calls you up and asks you to do something, you should consider it. So I would take the call and consider it and think about why and what they want, et cetera.
Well, you can watch more of that interview on the David Rubenstein Show, peer-to-peer conversation up next week. Now, Wall Street's 5 biggest banks reported a record-breaking $134 billion in trading revenue last year. And the chief executives say that's just the start. Here's Morgan Stanley's Ted Pick.
We are well served to watch for any overreaching against ongoing global uncertainties and higher asset prices. 2025 results, and in fact, the results for every quarter over the last 8 are a blueprint for Morgan Stanley's success. We expect this mix of tailwinds and headwinds to prevail in 2026 and are prepared to continue to execute.
Well, with us now, Paul Davies, Bloomberg opinion columnist, and Tom Metcalf, managing editor for EMEA Finance. Thank you both for joining us for a good banking panel. Paul, what did you see, or what did we learn actually from Wall Street?
Well, as we just heard, record revenues. It was an incredible year last year, lots of volatility. I mean, I think equities did particularly well, and I think that's a really fascinating story in part because we've also been tracking the kind of the threat, supposedly, from the electronic market makers, the Jane Streets and the Citadel Securities and that sort of thing. And I think one of the things it shows is just how different a lot of these businesses are, traditional Wall Street versus the new guys, and they both get to make money at the same time. One of the most important things I think about the equities business in particular is the banks are earning a lot more like asset managers in the sense that their revenues are very geared to the valuation of the stock markets through the lending that they increasingly do to sort of very large hedge funds through prime brokerage business, and also a lot of the derivatives activity, which is now, involved a lot more in things like quantitative investment strategies, designing sort of cheap fund-like products for their clients, which again are very geared to markets.
Yeah, and I mean, you can see the trading record is, some say, look, it's just starting. Certainly the bank CEOs would hope so, and they're saying it quite openly. Goldman also raising some $16 billion in this massive Wall Street bank bond sale. Where was the weakness?
Yeah, I mean, that's kind of interesting thing to pick out. It's probably less on the Wall Street side, sort of the capital markets, but much more on, the retail bank side, where you do have that sort of, very big risk of, what will Trump do next? So dominating JP Morgan's results, Citi, Bank of America, was this concept of, a credit card cap on interest rates, which they were very clear on would really hurt those businesses. But, broadly speaking, these banks are making more money than ever. And so how the investors react now, obviously a massive run-up in shares already, is really where those risks are. And actually, I was reading Paul's column on the equities trading. It's really interesting. They're saying ideal setup. But I think, Paul, you're saying 2026 still looks good. But after that, can this really, this won't continue forever?
Yeah, of course. I mean, as I was saying, it's about valuations. We know that markets are very exuberant, both credit markets and stock markets. There's lots of stuff still coming to support sort of further growth in the economy and market performance in terms of some of the tax breaks and the one big beautiful bill, in terms of private equity activity. There's still kind of a wave of IPOs that people are expecting, but then that's set off against all of the uncertainties of Trump's policy making, of geopolitical risks, of potentially more inflation coming through, especially if we get a Fed chair who wants to lower rates to please the president rather than manage the economy.
But were you surprised? So my head's in Davos mode, and of course we're expecting the president to show up, possibly try and talk about the affordability crisis in Davos, which seems strange. So it's unclear whether he rounds up the private equity titans or the bank chief executives and kind of gives them a lecture. But it was interesting to see that JP Morgan and Citi don't feel this affordability crisis. This is your column from yesterday or 2 days ago in their numbers.
Yeah, and I think that's partly because they just don't really serve the poorest sort of 10, 20% of the population because those with like very, very low credit scores just don't get access to credit at the very large banks. They avoid them. So in some senses they don't feel it. But also, I think there's a large swathe of the US consumer for whom, sticker shock, the experience of seeing things costing a lot more than they used to still resonates, while actually they can afford to do some of the things that they really want to do. And a lot of the spending on cards that the banks were reporting, we had like retail sales numbers this week as well for November, and its car sales are growing very strongly. It's kind of the holiday spending on nice things is still going well. So it's it's a bit of a puzzle.
What can you tell us on IPOs or deal making in general?
Well, I think IPOs is one area where, there is potentially upside, right, even in the US. But, sitting from my seat in Europe, like there's just been really
Well, people are hoping.
They're hoping, yeah. And that's the funny thing is, you talk to the bankers, as you'd expect, they talk a great game, right? Like, it's all about 2026. So we have a good story today about JP Morgan planning to hire across Europe because, they are seeing or talking to investors and going, no, there's, good sentiment out there. And, of course, for me, the interest there is, you've got these massive US banks doing very well, on a different scale to even the largest European banks, to be frank. And that's a big worry, just from a competitive point of view, because if a JP Morgan decides, look, we really want to get in there even more than they are, they've got the resources to basically do what they want, and that's probably what's keeping up European executives.
So what this would be them actually getting the IPOs, or also is there a worry that they scout the best talent from European banks because they can afford to pay them more?
Yeah, well, they just see more of a pipeline, so let's see if that comes to pass. JP Morgan was the one Wall Street bank where the deal making actually disappointed in the fourth quarter, but they're saying, look, there's enough demand here for us to effectively expand our footprint. And, if you're an ambitious banker, the Wall Street cachet, definitely large. You'd probably rather work for them, and they can certainly pay the most.
Yeah, JP Morgan, had a bit of a wobble. We're so used to them beating everything and everyone that actually this time around it could have been better.
Yeah, no, it was very surprising. I mean, on the day it didn't seem that bad, but after everybody else had reported, it was really noticeable that in deal advisory and in debt capital markets in particular, they really missed a trick in the fourth quarter. Their revenue shrank compared to the fourth quarter last year, while Goldman and Morgan Stanley were both up like sort of 40-something% in deal advisory. Citigroup was up like 80% in deal advisory. I mean, that's probably because they had a particularly poor quarter in the year before. But yeah, it's very surprising. And now, at the time, Jeremy Barnum on various calls was saying some of this is just about timing. Things got pushed into the first quarter of this year, which, can make sense. But he also said there are things that we need to look at, and maybe some of this hiring is part of that.
Yeah, do we know why they weren't as good as some of their competitors?
No, and that's the thing to find out, because like you say, JP Morgan normally, a banner bank on the deal making, and it's all coming from very, very high bases, right? So you have that context. But yeah, I was a bit like Paul. Yeah, kind of as the week went on, you went, oh right, this is something even more worse than it looked like at the time.
Okay, well hopefully we'll get to speak to some of the executives also in the next couple of weeks at JP Morgan. Thank you both for joining us. Tom Metcalf, managing editor for EMEA Finance, and Paul Davies, Bloomberg opinion columnist. Now, coming up, President Trump has repeatedly said he deserves the Nobel Peace Prize, and now he has one, despite never winning the award. That story's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The record-breaking stock rally gains fresh momentum as earnings from the chip maker TSMC revive confidence in the AI boom. While Wall Street's biggest banks record their best-ever quarter for trading revenues and say the best is yet to come. Plus, the Venezuelan opposition leader gives her Nobel Peace Prize medal to President Trump as she seeks a role in the future of running her country. Now, Denmark and Greenland are seeking congressional support from U.S. lawmakers to push back on President Donald Trump's desire to take control of Greenland. A group of U.S. senators is set to meet members of the Danish parliament in Copenhagen today, including Jean Shaheen, the most senior Democrat on the Senate Foreign Relations Committee. Well, she told Bloomberg that the White House should focus on diplomacy.
I don't think there is any concern on the part of our allies, Denmark and Greenland, about partnering with the United States. And that's the route we should be taking. It should be diplomatic. We should be engaging in conversations if there is an interest on the part of this administration in additional operations there.
And you can listen to that full interview on the Michelle Hussein Show out later today. Now let's get more from Sarah Srolin, Bloomberg's Copenhagen bureau chief. Sarah, thank you for joining us. After a week of really frenzied diplomacy, what has shifted?
I think the temperature has probably taken a notch down. It's been very high tension in Copenhagen, Nuuk, and probably also Washington this week. But after the meeting between the Greenlandic and the Danish foreign minister and Rubio and Vance on Wednesday, where things did not escalate, there was some concern here in Copenhagen that things would explode after that, and it hasn't. So I think we moved the discussion from the public, from the media, from social media into more diplomatic circles, and that seems to be a win for the Danish officials.
So what's Denmark's strategy going forward?
It's definitely to try and pursue a more measured discussion in this working group that they set up. They're supposed to meet within the next few weeks, and then every 2 or 3 weeks following that. There's still some debate between Copenhagen and Washington what this working group is set out to achieve. Is it still for the U.S. to take over Greenland, or is it to try and find a diplomatic solution where maybe Denmark agrees to more military, NATO steps up its presence? But I think for now, Denmark is just really happy that there seems to be a path forward where they can talk in a more closed room with other diplomats.
Sarah, thanks so much. Sarah Srolin there, Bloomberg's Copenhagen bureau chief. Now, earlier this month, President Trump dismissed the Venezuelan opposition leader, María Corina Machado, saying she had no support or respect. But in a meeting at the White House yesterday, President Trump praised her after Machado gave him her Nobel Peace Prize, something Trump has frequently said he deserves. Now, let's discuss U.S. policy in the country and wider geopolitics with Laurel Rapp. She was previously at the U.S. Department of State and White House National Security Council and is now director of the U.S. and North America program at Chatham House. Laura, thank you so much for joining us. I know it's been extremely busy, so we're extremely grateful that you're giving us a little bit of your time. What happens in Venezuela is at the moment quite complicated to understand the way forward, whether we are going to see some stability. But is it really the blueprint of what we could see in other countries, or is Venezuela different?
We're seeing in this new year a very aggressive foreign policy move across 3 continents, in Latin America, in the Middle East, and in Greenland, in Europe as well. And so we're seeing a president who feels unrestrained, who feels quite emboldened from his U.S. military action in Venezuela, that by all measures, if you are seeking to remove this leader from Venezuela, was a success. It did not collapse the economy. It did not collapse the security structure of that country. And so presumably in his view, he sees that as a potential success and a model to emulate elsewhere.
Are there any limits to what the Trump administration thinks it can do in matters of foreign policy? Like, I mean, what happens with Greenland if you're European is quite shocking at the moment. Even seeing some of the NATO helicopters having to land a couple of days ago to make sure that they defend it. But it's unclear what the Trump administration would actually do.
We're not really seeing those meaningful constraints we've seen in past foreign policy decision-making processes. The U.S. Congress has not been able to pass legislation to constrain the president in the War Powers Act. The U.S. public opinion, although it is broadly opposed to the foreign policy actions the president is taking, it hasn't yet really come push to shove as the midterms approach 9 months from now. And in terms of the partner responses, fairly muted response globally on Venezuela. We're seeing a different, potentially more forceful response on Greenland, particularly from NATO allies, in which the U.S. has a mutual security treaty. Remains to be seen how the U.S. and Europe seek to move beyond this very heated, very norms-breaking impasse. we're at an impasse right now.
What would deter actually the U.S. to move aggressively in Greenland? And again, I don't know whether it's force or whether it's friendliness, like we saw with the Venezuelan opposition leader and the Nobel Peace Prize at the White House yesterday.
Look, Europeans are in a tough spot right now. I think there are two paths. One is the path of offering an off-ramp, providing some assurances that security will be bolstered in the Arctic, in Greenland. And we're already seeing European member states send additional troops. This is the purported reason for why President Trump wants to take Greenland. He says Russia and China is threatening its security, threatening our access to the Arctic. So the Europeans have called in President Trump's bluff and said, we're going to put up more troops to deter against this meddling in our region. So far, according to the White House press secretary yesterday, she said the president remains very interested in owning Greenland and additional European troops will be insufficient.
Laurel, does this go back to the midterm, that actually there was a bit of a wobble, it felt like, in the Trump administration because the polls were so bad, and suddenly the focus is on affordability and actually critical everything, minerals, critical oil, to make sure that people get a better living standard in the U.S.?
That's right. The main issue that elected President Trump in the first place, and the main issue animating voters right now in the United States, is affordability, is on economic issues. And one thing we're seeing is President Trump has not really been making a very strong case to the American people about why Venezuela, why Greenland, why Iran connect directly to answer this question for American voters. We've started to see that on Venezuela with the $2 billion U.S. transfer of Venezuelan oil that President Trump says will bring down gas prices around the country. But we haven't seen that argument made in Greenland. We haven't seen it made with Iran. And that's going to really be a question Americans have. Americans broadly say, according to recent polling, that they disapprove of his handling of foreign policy. They do not want to see military U.S. action in Iran. Absolutely not in Greenland, and concerns about Venezuela, too.
Okay, Laurel, don't go anywhere, because we'll talk about Iran. In Iran, the Islamic Revolutionary Guard remain firmly in control amid the deadliest anti-government unrest in the country since the 1979 revolution. And even if protests come to an end, it seems the IRGC will play a pivotal role in what comes next. So let's get more on today's Bloomberg Big Take with Patrick Sykes, our breaking news editor in Istanbul, who focuses on Iran. So what are the scenarios, Patrick, and how does the IRGC fit into them?
Hi there. Yeah, we've pulled out a few key scenarios today in this big take. So one is a kind of leadership reshuffle that sees a strong man, or perhaps multiple strong men, emerge from among the elite. Second is a coup, a direct military takeover. Third would be a kind of slow decay from the existing uneasy status quo shortly before the protests. And as far as we see it, no matter how you cut it, in all of those scenarios, the IRGC is going to be key to whatever comes next. You know, think of the kind of the extent to which it has people active, current and previous members right across different branches of the state. Its status as the most powerful military organization in the country, far more powerful than the conventional army. And then the real turning point that we haven't seen happen also runs through them. That would be if we saw defections from the security forces, most significantly from the IRGC itself.
So what about ideology? If the IRGC is supposed to be protecting the system and the supreme leader?
Yeah, it's there in the name, right? The Islamic Revolutionary Guard set up back in '79 to protect that revolution, also to counterbalance the conventional military that was viewed with some suspicion. But since then, in part thanks to sanctions, in part thanks to the Iran-Iraq War of the 80s, and the way that Iran's economy has been constrained, their profile, their influence in everything from the economy, finance, oil trading, engineering, infrastructure, all the way through to I don't know, their conventional military capacities has just ballooned. So now they're a huge actor, far beyond their original purpose, and they've kind of increasingly captured the state that they were formed to serve. So that makes us think that, you know, that they care as much about their own interests, you know, personally, institutionally, as they do about the revolution. It's there, the ideology, to draw on if needed, but it's not, I think, the limiting factor that their name suggests it might be.
All right, Patrick, thank you so much. Patrick Sykes, Bloomberg's breaking news editor in Istanbul. Laurel, when you look at everything that's happening in Iran, the president of the U.S. saying there could be strikes, there are no strikes. Like, what is this symptomatic of? Does the U.S. really want to get involved?
President Trump did get involved last summer against naysayers and those that said a strike on Iran's nuclear capabilities would be too risky. Those voices were proven wrong in his view. He was able to degrade Iran's nuclear capability, unclear to what degree, how soon it can, or if it would be rebuilt. But he likely brings in a lot of confidence to Iran right now to say we can do things there without major U.S. risk to our interests. We'll see now what this looks like. We are in a very heated, a very high-wire act here in Iran. Seems the president has stepped back a little bit in the last couple of hours or days, but he is quite bullish on the expansive role the U.S. can have in the world. We haven't really seen him in other conflicts be quite interested in supporting human rights and democracy. Protesters, we're seeing a little bit of that here, and that's likely not the driving motivation. It's more of a U.S. power projection, and if we can do it, maybe we will attitude. But the days and weeks ahead will be critical here.
Laurel, Venezuela and Iran, of course, it's oil, but this also means that you're really antagonizing China because, especially in Iran, they're the biggest, buyer of Iranian crude. So how does the U.S.-China play out? I know there's been easing of tensions towards the end of the year, but could this be really flared up?
U.S.-China relations, we've seen so many headlines in the past couple of weeks alone, but they haven't centered around U.S.-China tensions. And that is a theme that is a through line through all of these pieces. President Trump reportedly will go to China this spring to meet with President Xi. And President Trump is always looking for leverage and power and improving his negotiating position. And all of these moves will feed into those conversations about this expansive role for the U.S. in the world, of the U.S. being unafraid to use military force around the world. And that is potentially a way that the U.S. may see to improve its negotiating position with China.
Laurel, there's also so many questions about whether this is being done, and we touched a little bit about affordability in the U.S. and the fact that, the President Trump is not very popular at the moment, if you believe the polls, which maybe some don't. But there's also, everything that's happening with ICE and immigration. Does he have support for that? Or is he going also for foreign policy as a distraction of what's happening at home?
According to recent polling, Americans are widely disapproving of his handling on foreign policy matters. They've given him slightly more latitude on immigration. The country's very divided right now on how this president is handling customs enforcement. We've seen these very shocking images out of Minnesota with the death of a civilian there, a mom of 3 children. And so the immigration crackdown is escalating in the U.S. The White House may see that as an area that they can move a little bit more freely. But from an international perspective, when you look at the U.S., these sorts of moves are only driving polarization and are creating a very tense domestic environment right now.
Laurel, thank you so much for everything. Laurel Rapp, Director of the U.S. and the North America Program at Chatham House. Coming up, what does it mean to build an aspirational brand with commercial viability in 2026? Next, we change tack. Away from foreign policy, we talk luxury and the luxury sector. That's next, and this is Bloomberg.
Next week, live from the Alpine Mountains of Switzerland, is the World Economic Forum annual meeting in Davos. Bloomberg Television brings you unmatched coverage and conversations with world leaders, business executives, and billionaires as they navigate responsible AI deployment, economic expansion, and geopolitical tensions. Tune in for daily coverage all next week. Context changes everything.
Well, traders in the Japanese yen are on edge for the risk of renewed volatility with uncertainty over snap election and a BOJ decision next week. The yen hitting its weakest in 18 months earlier this year on expectations of an early election. Well, Bloomberg Originals has been looking at how consumers and businesses are coping with rising costs due to a weaker currency and what it means for the future.
In 2016, this Japanese company issued a public apology. For the first time in 25 years, they were hiking the price of a popular ice cream by 10 yen, or about 6 cents. And they were deeply sorry. Now, in any other country, this might have been an overreaction. But in Japan,
inflation is just completely alien as a concept.
For 3 decades, the country saw stagnant or even decreasing prices, which is why a 10 yen price hike for an ice cream was such a big deal. But a huge slide in the yen is helping change that picture. And it's causing a seismic shift in Japan's economy. The yen has weakened against the dollar to a level not seen since the early 90s.
The weaker yen means higher prices for all sorts of imported goods, from groceries to gasoline.
It's also making it pretty attractive for inbound tourists looking for a cheap vacation. Steering the country through this once-in-a-generation cost of living crisis is the inaugural challenge for Japan's new leader.
Tsunai Takaishi has been voted in as Japan's first female prime minister.
Japan has arrived at that big moment where there's a potential transformation of the entire society.
Well, subscribers can watch that documentary right now on the Bloomberg terminal and on Bloomberg.com. It's also available on Bloomberg Originals' YouTube channel. Now, if earnings are anything to go by, yesterday's strong results from jewelry conglomerate Richemont show that the luxury sector is in rude health. Yet earlier this week, luxury retailer Saks filed for bankruptcy after failing to make a merger with Neiman Marcus work. So what does it mean to have a successful luxury brand in 2026? And how important are physical stores these days in building brand presence and driving sales? Well, we're delighted to be joined by Erwan Rambourg, Global Head of Consumer and Retail Equity Research at HSBC, and with us, well, with me here in the studio is Andrea Felsted, Bloomberg opinion columnist. So thank you both for joining us. Erwan, just give me a sense of how you think luxury will change in 2026. Like, what do people have enough money to buy for, luxury, or do they find it too pricey and expensive because it's risen so much? And is it jewelry or handbags that people want?
So thanks a lot for having me, and good to see you and Andrea today. You've had 2 years of very muted sales growth, 2024, 2025, with notably, to your point, the aspirational consumer being priced out. We wrote a lot about greedflation, the idea that many brands went too high too quickly in terms of price points. And very clearly, this was an issue more on the fashion side, so handbags and accessories, than it was on jewelry. So as a consequence, jewelry ended up being a lot more resilient, and handbags and accessories were under pressure. But alongside that greedflation, I think you also had a lack of creativity. And one of the reasons we're more constructive, despite listening to your program and being a bit stressed out about the world, is that I think you're seeing a lot of new initiatives in terms of product, in terms of pricing, to basically have that aspirational consumer who disappeared over the past 24 months come back somewhat. So we've been bullish, optimistic, constructive on jewelry, but we do believe that certain handbag and accessories brands will come back this year after, again, 2 years of misery.
Yeah, and Andrea, I mean, we love a bit of jewelry. I don't know if we're like the target audience, but we do like looking at it. The biggest surprise for me was over the last couple of quarters, actually, luxury is back.
Yes, indeed. It does seem that we are sort of through the worst. China seems to be stabilising. The US consumer, particularly the wealthier consumer, is spending again. And what was notable with the Richemont numbers is that they compared with a period a year ago when we were all very upbeat on luxury because we'd had the US election. That seemed to unleash a wave of spending among US consumers. That sort of came to a halt with tariffs. But Richemont showed that it's, even with those tougher comparisons, those that are doing well are still doing well.
Erwan, you like Richemont, you like LVMH. What does LVMH have going for it?
I think LVMH, well, what it has going for it is positioning, in the sense that investors will be hiding in Hermès, will be hiding in Richemont, but I don't know a lot of investors who are buyers of LVMH, and I think if there are indeed signs of life, that will be the first one that investors will start looking at, because it's liquid, it's a very large cap in Europe, and it's seen as a proxy. What is very specific to the LVMH story this year is what we believe will be a quasi V-shaped recovery for Dior. Talk about lack of creativity and maybe overpriced products. I think Dior had become a bit stale over the past 2-3 years. It had become a bit repetitive, and you didn't have a lot of incentives to push the door. I think you've had a lot of management changes happening there. You've had a few product initiatives, and no one's a savior, but you do have the arrival of a very gifted creative director, Jonathan Anderson, who is working wonders at Loewe, another of LVMH's brands. And I think there's a lot of excitement. I mean, you saw a sort of revolving door of designers, a change at Chanel, a change at Gucci. This change at Dior, I think, will move the needle quite significantly. It's only starting now. None of his products were in store in 2025, but you already had signs of an increase in traffic, in interest for the brand. And I think that will translate into very strong growth for Dior. Now, obviously, the key asset at LVMH is Vuitton, which is about half of profits, and Vuitton is also doing okay. But Vuitton is very big, so it was probably slightly down next year. It'll be slightly up this year. Dior, in terms of recovery, I think will be a lot more visible.
Yeah. And this is what you were saying, Andrea, is that, I mean, it's really a tricky sector, because so much depends on the creative director and whether, kind of what appeals to people, which is something so soft. You can't really put measures on it.
Exactly. And as Erwan says, we've got this sort of period coming up sort of over the next few months, which is going to be the big test. We've got with Dior, Gucci. The next show for Gucci will be his first outing. He had the crazy film back in the autumn, but, the first show, proper show, will be in a month or so. So it's going to be really a test, and it's really going to see whether handbags and leather goods can steal back some of those sales from jewellery.
Are we still in the quiet luxury phase, Andrea?
No, I think quiet luxury is over.
So where are we?
I think we're in the death throes of quiet luxury, but I don't think we've yet come back to maximalism. We're definitely smartening.
We're in purgatory. We're
definitely smartening up, and there are signs of some, more ostentatious luxury flourishes. Obviously, we've got Gucci. Demna sort of hit on a few of the sort of typical Gucci things, like the logos. So I think we're in the death throes of quiet luxury. I don't think we're quite yet back at maximalism yet, but I keep reading that after the 90s, the 80s is the next decade to have the nostalgia. So we could see
the flare pants and the metallic
shoulder pads, cinch waists. So maybe the 80s will bring back some power dressing.
And Andrea, it's always the U.S. consumer, right? That's still the most important person.
The U.S. consumer and China.
And China's back?
China's stable. I'm not sure if it's quite back, but it's going hopefully in the right direction.
Yeah, Erwan, what are you seeing in China?
Yeah, I think to Andrea's point, China is stable, but stable is the new up, right? Because not that long ago, China was down double digits. You have two engines of growth, to be fair, in the luxury space. The Chinese are somewhat still, depressed, linked to the property market, linked to youth unemployment. But as a CEO in the space told me not that long ago, you can't be down 25% on 25% forever. At some stage, you find a level. Yeah. I think there's a lot of negativity and this perception that Chinese have lost interest forever in luxury is factually wrong. And then the other engine of growth is the US, which is more related to equity markets, and here there's a nice correlation with luxury demand.
Yeah. We're on a tear for the moment. Erwan, thank you. Erwan, Global Head of Consumer and Retail Equity Research at HSBC, and, of course, Andrea Felsted from Bloomberg Opinion. A reminder, our special coverage of WEF starts on Monday. We'll be live with the Pulse there all week.